the industry in general is moving away from these really high-level aspirational commitments and focus that are all really well-meaning to looking at a more business-first approach. Like, how can this, in the short and medium term, like help our business succeed?
Welcome to Sustainability Leaders. I'm Michael Torrance, Chief Sustainability Officer at BMO. On this show, we will talk with leading sustainability practitioners from the corporate, investor, academic, and NGO communities to explore how this rapidly evolving field of sustainability is impacting global investment, business practices, and our world.
The views expressed here are those of the participants and not those of Bank of Montreal, its affiliates, or subsidiaries.
Welcome to another episode of Sustainability Leaders. I'm Melissa Fifield, head of the BMO Climate Institute. And today I'm excited to be joined by two of my BMO colleagues, John Uhren, Global Head of Sustainable Finance for BMO Capital Markets, and Nalini Feuilloley, Head of Sustainable Investment in BMO Global Asset Management. Welcome, John and Nalini. Thanks for joining me today. John, I wanted to start with you. In a Sustainability Leaders podcast episode we recorded last fall after New York Climate Week, we talked about the cautious optimism we felt as it relates to corporate climate action and sustainable finance writ large, and climate pragmatism, a focus on the commercial impact of energy efficiency, for example. Now we're well into 2026, and I'm curious to check in with you to see how things are evolving from your perspective.
Oh, thanks, Melissa. I mean, look, if you were just to read the headlines and read the newspapers, you might think that sustainability is dead, that the conversation is finished, that it is black and white and complete, that this will no longer be an area or an issue that companies, issuers, investors are thinking about. But like the fact of the matter is this continues to not be the case, right, in the real world and in the economy. And there are some headwinds in the US for sure, but things haven't slowed down globally. That continues to be the case, right? It's really about deploying optimal capital and efficient capital in a way that has environmental and social impact, but of course, helps the companies succeed and compete in the real world.
Thanks, John. Nalini, from your perspective at a top line level, sort of what are you seeing from a sustainable investment standpoint, big picture?
Yeah, so big picture is very similar to the way John contextualized it. Environment, yes, there are headwinds. Yes, the external environment is uncertain at this moment in time as things are shifting really rapidly. But I actually think the fundamentals of sustainable investment are still what they were 10 years ago today. I think it's maybe the syntax or the semantics or the disclosure, some very specific areas that are maybe being called into question, and we're seeing the pendulum swing about. But at the end of the day, as investors, we're looking for decision useful information for our investment processes. We want to understand what is material to the businesses that we're investing in, not only today, short term, medium term, but also in the long term. And so as a result, our work hasn't changed. And we're seeing a lot of kind of CapEx allocation happening in the industries in which we invest in sustainability because it just makes good business sense.
I think at this point last year, sustainable loans specifically were heavily concentrated in industrials and technology, companies like John Deere, Ford, Intel, HP, big names. What's driving demand in those sectors?
From like an industrials perspective, it's really about the fact that they're incredibly capital intensive operations, right? And we're seeing like higher energy costs, higher input volatilities, supply chain resilience, requiring more investment in a way that maybe looks different than it did 20 or 30 years ago. And so electrification, that's going to be critical for the long-term success of an industrials company, but that's expensive up front, right? And that's some of the really capital intensive decisions that CFOs and treasury folks are having to make right now on the ground level to say, is this going to align with our overall objectives as an organization to make this capital intensive investment?
I want to pivot a bit to talk about sort of some of the things that we're seeing from a microenvironment beyond the business fundamentals. We're seeing increased scrutiny on sustainability frameworks. We're seeing regional divergence and policy uncertainty in different areas. How is this shaping the way sustainable investment is defined, implemented, evaluated? both by asset owners and by the institutions that are structuring or distributing that capital?
Really great question. So maybe I'll start with the asset owners or the allocators, if I would. In our view, they really sit at the top of the investment food chain. Their interests trickle down all the way to not only asset managers like us, everybody in our institution here at BMO. So their interest and demand for all things related to sustainable investment, in my view, has not changed fundamentally. In fact, there are table stakes expectations that all material risks are taken in consideration and all opportunities are exploited for alpha generation. And they can even go as far as to want to influence the companies in which they invest by being active owners, how they vote their proxies. For asset managers, though, I think it's a little different. I have seen two shifts in our space, and I think the first is really around disclosure and just the alphabet soup related to sustainable investment. Think ESG as a term, impact investing, TCFD, SASB, and I can go on and on. I think like the pullback from this hyper focus in this area is something that needed to happen and is happening because what we're trying to do is integrate this space very much into that mainstream investment bucket that we sit within. The second shift, I would say, is also the industry in general is moving away from these really high level aspirational commitments and focus that are all really well meaning to looking at a more business first approach. Like, how can this in the short and medium term, like help our business succeed? And so looking at the risks that are material, looking at the opportunities to be had, not tomorrow, but like down the road.
Energy continues to sit at the center of many sustainable finance flows. For example, as of December, renewables accounted for 26% of green bond issuance and 53% of use of proceeds lending. What's sustaining this dominance? And where do you see the next wave of energy-related opportunities emerging?
We still see a lot of green issuance and allocation to green projects for a few reasons. One, these tend to be very capital intensive. So a lot of the energy transition pathways are longer dated, but with that means they're sort of more capital heavy or capital intensive upfront. And then you have renewables projects that fall within that green bucket that often have larger ticket sizes, which align nicely with the public bond market, align nicely with syndicated loan markets. You'll often have contracted, predictable cash flows on the other side. So PPAs or regulated tariffs that really enhance or underpin the credit quality of the issuer or the borrower. And then to an extent, you have some predictability and understanding of what is considered green based on market standards, be it principles, taxonomies, or just issuances through time and second-party opinions that exist in market, considering what is green and what's not. So it kind of eliminates some of that structuring friction associated with different activities that might be more so on the margins. Green, because they've been around, labeled green bonds, I think since 2007, we've just seen a lot of examples and the market has a pretty good understanding of what is and isn't green. When I think about the next wave, AI and data center investment, clearly that is going to be a major, not just green form of financing, but just form of financing in the future. In 2025, I think we saw 38 billion in sustainability linked loans that were specifically targeted towards data centers. And data center operators have become pretty material sustainable or green bond issuers as well. And that's separate and apart from some of the mega users that we will see tap this market from a power perspective as well. So I think there's a lot of activity in this space. I think the green segment produces one where there's a flight to familiarity and a flight to quality for investors that will continue to show this to be the most resilient theme that we see going forward.
When we zoom out and look across the landscape, where do you see the biggest opportunities by sector or instrument or geography? Where do you see the sustainable finance market moving over the coming quarters? And Nalini, maybe I'll start with you actually on the core investment themes.
So thematically speaking, it's actually quite simple right now in our wheelhouse. We're really hyper-focused on geopolitics as a theme, just because that is obviously causing volatility in the markets and something that we want to get a handle of sooner than later. So it's not necessarily an investable theme, but it is a theme that we're talking a lot about and that we're following very closely. I think from like just a sustainable investment perspective, the energy transition continues to be one that we follow very closely, like looking at critical minerals, the mining sector, battery storage, and just really the opportunity side of the equation. I think there's actually a lot of lessons that we can learn from our recent past, right? When we think about the global south, we think about some of the transitions that have been made in larger economies like China, and like how can we apply them to other global south regions that are probably going to go through a similar change, and where are the opportunities to kind of support that. So energy transition from an investable area, and then of course AI, and understanding like how do we use limited resources to support this demand in a responsible way. We look at things like water scarcity, recycling, circular economy. All of these things play a factor into these really massive growth areas. And so they're all interconnected.
Well, I love Nalini called out geopolitics, and I would frame that like from an energy security perspective, like that's become so relevant and topical for the way that we have countries, corporates, like government agencies, SSAs looking at the role that they play in ensuring energy security. That is now falling into the sustainability discussions because it is seen to be critical to companies being able to continue to operate as sovereign entities. So that's an interesting topic. Nuclear is one area that we circle and spend a lot of time with at BMO. Certainly within the Canadian context, we saw nuclear be added to the Government of Canada's Green Bond Framework at the end of 2024. We've seen a few other sovereigns, namely the UK, Italy, and the EU as well, all added nuclear provisions to their frameworks last year.
One significant development over the last few months was the release of the Government of Canada's budget, which outlines 4 pillars to building a stronger Canadian economy. The 4 pillars being accelerating major nation building projects, supercharging growth, Canada's climate competitiveness strategy, and finally increasing competition. Related to the Major Projects Office in particular, to help those clean growth projects get built faster, which include energy, mining, infrastructure projects. What impact is this having, or do you anticipate it will have?
I think they predict that if the average timeline to approve a major project is around 5 years, if they can get that down to around 2 years, and this is just what's being predicted, then that is materially critical as we think about improving both regulatory certainty, but ultimately investor confidence and stakeholder confidence, Canadians' confidence in the fact that we will actually see these major projects through to completion. So I think the Building Canada Act, which effectively formed the Major Projects Office, will really allow these projects to get built faster in key areas and across key geographies within our country. I think the MPO, the Major Projects Office, will also create a few other benefits, including a stronger pipeline for access to the Canadian Indigenous Loan Guarantee Program. Canada has stood up a $10 billion Indigenous Loan Guarantee Program that can stack on top of existing provincial loan guarantee programs to really allow First Nations to be at the table to make material investments and take material positions in some of these assets. And the MPO will help coordinate some of those activities as between the different loan guarantee programs that exist in market. They'll also support some of the financing coordination through government bodies like Canadian Growth Fund or the Canada Infrastructure Bank, effectively kind of quarterbacking the different project development approvals, risk-sharing tools, really allowing the full unlock and unleashing of what CIB and CGF are able to offer as it relates to capital deployed. And finally, the MPO has an Indigenous Advisory Council, which I think is critical to really assess some of the ways in which the Indigenous partners are being consulted, the way they're being brought in for some of these equity participation arrangements. I think this will be really important in understanding and ensuring that the needs of the Indigenous groups are being met, but also that they're being fairly consulted and fairly brought in as key partners across these major projects.
Nalini, what parts of the budget are you watching from an investor perspective?
We were really interested in the clean economy investment tax credits, which are available to all companies in sectors like energy and mining without requiring a specific referral to the MPO. And we were excited to see Canada reaffirming commitments to transition finance, the transition taxonomy, and what that means in terms of opportunities to invest beyond green instruments. I think it was in the arena of $10 billion Canadian for transition bonds to be coming online, hopefully by 2027. We're really excited about that. From an investor's perspective, when we think about our fixed income desk and how and where we invest right now, it's always a mad dash when it comes to green bond issuances. They're always oversubscribed. And so we're really excited to see where transition finance will land.
We talked a little bit about energy as it relates to sustainable finance and sort of investment themes generally. I want to talk a little bit about energy security. Obviously, a hot topic given the geopolitical environment lately. And we're seeing different approaches in the US and Canada related to energy security. The US focused on manufacturing incentives, a deregulatory environment, an increased focus on domestic production and larger government presence in critical minerals markets, whereas Canada is really emphasizing regulatory certainty, clean and abundant power, and strategically managed resources. Taken together, how do you see these different policy directions in both countries shaping corporate and investor strategies?
The best might be just to highlight like an example of what we've seen for a company that's operating both in the US and Canada, and that's Volkswagen. Through PowerCo, Volkswagen's battery subsidiary, they built a battery cell gigafactory in St. Thomas, Ontario. It's really intended to benefit from Canada's low carbon, reliable power source. And they're also investing in the supply of lithium from a couple of different parts within Canada. Now, concurrently, their manufacturing and vehicle assembly plant is in the US. And the purpose is because they're accessing larger EV demand pools, there's deeper supplier ecosystems. There's an understanding and sense that not everything has to happen within entirely in the Canada and the US context because there are benefits of being in both geographies. I think companies always need to take the longer view in terms of what's best for their operations, what's best either from a tax incentive or from a human capital perspective or from understanding the full integration of their supply chain, where it makes sense to have these different parts along the ecosystem and make that decision with a long-term view in mind. And I think the key for a successful company in this space is effectively managing everything that's within their control, doing the best to predict what sets them up for success down the road, but then owning it and understanding that they're within their value chain, that they can only control what they can control and trying to make the best of the situation.
We talked about some of the challenges facing companies, but investors have their own sets, including performance expectations, regulatory divergence that we spoke about a bit, and stakeholder scrutiny. Where do you see the alignment or the tension between what investors need and what corporates are able to deliver in the current landscape? Nalini, would love your perspective.
Yeah, absolutely. The external environment is quite complex right now. I think there are a lot of points of tension, and I actually don't think it's any one reason that is the catalyst for that. I think with regards to performance expectations, those have always been there since the beginning of time. What I do think we're seeing some misalignment on, and again, it's because we were kind of on pace and we were getting closer to more of that comparable decision useful information being mandated from corporates so investors could use that information to the benefit of their investment processes. And unfortunately, a lot of the developments that were happening with regards to global disclosures through the ISSB have kind of waned. It's not necessarily on hold everywhere, but the uptake, especially here in Canada, it's very much on a volunteer basis right now. We were moving really fast in the direction of what I was envisioning as mandatory disclosure. What's been more problematic for us is what we call green hushing that I mentioned earlier, which is this move away from talking through commitments or even active work that's being done in the sustainability space for companies that are not necessarily operating naturally or in an organic, sustainable way. And so what that means is that we're spending a lot more time talking behind closed doors with the companies that we invest in or the companies in our investable universe to get information that they have on hand, but they choose not to disclose in the public sphere.
Quick lightning round to pull us to a close. What are you most closely watching over the next 12 to 24 months?
Well, I'm very interested in the fact that 31% of sustainable bonds will mature in 2026. And in light of this really informative conversation, Nalini, I've learned a lot from you around how investors are looking at sustainable labeled debt. I'm curious to see whether or not corporates continue their programs, whether they'll continue to issue under their ESG bond programs in light of some of the pushback we've seen. So geopolitical, also just regulatory, legal, the fact that we don't have disclosure requirements. I think there's ample opportunity, not just within green or social or sustainability, but in new areas like transition, like climate resilience and adaptation, affordable housing. These are all really important, really financeable areas that require a ton of influx of capital over time. We have issuers that are allocating or considering allocating to these topics, but I guess the question becomes, are they willing to do it under a labeled bond program, or are they just going to continue labeling it under conventional bonds or conventional debt? It'll be interesting to see that over the next 12 months.
From my perspective, there are so many exciting things to come in the next 12 to 24 months. So we're following very closely the transition taxonomy framework here in Canada and what that means for transition bonds. We're really excited about that. We think they're necessary. We've actually thought that transition doesn't happen overnight. And this is why we exactly need to support the companies that need more time to get to the place that we'd like them to see them get to, environmentally speaking.
Fantastic. Well, thanks to you both for joining me for this really robust conversation. I really appreciate your insights and your perspective and really look forward to continuing the conversation. So perhaps we'll get together again soon and we'll check in on these themes in the next few months. Thanks, Melanie. Thanks, John.
Thanks for listening to Sustainability Leaders. This podcast is presented by BMO. You can find our show on Apple Podcasts, Spotify, or your favorite podcast player. Press the follow button if you want to get notified when new episodes are published. We value your input, so please leave a rating, review, and any feedback that you might have, or visit us at bmo.com/sustainability leaders. Our show and resources are produced with support from BMO's marketing team and Puddle Creative. Until next time, thanks for listening and have a great week.
For BMO disclosures, please visit bmocm.com/podcast/disclaimer.